Okay class, welcome back to our tutorial class. So today we are going to continue exercise for chapter 2. We are going to use this question December 2019 past year question December 2019. So please refer to question 2. This question 2 is for chapter 2. Alright, again, the format for question 2 is similar as question 1. So you have two main question. A is for the theory part, B for the computation part. Okay, let us look at the theory part. A, you are required to define two charges over debenture. Okay, so let us recall chapter 2-1. 2-1, that is introduction to company. So you have been introduced one of the loan capital, that is debenture. And in addition to the debenture, you also learn about the charges over debenture. Charges is like something as a backup. When you borrow loan, so you must have a backup for the loan in case if the company is fail to pay for the interest and so on. So as the backup, okay, we can identify there are two charges. One is what we call fixed charge, and the other one is floating charge. Fixed charge is where the company will determine specifically the assets to be used as a backup for the loan. So the company must identify the item specifically. So this item later on will be locked. It cannot be used by the company. It cannot be sold for the company. It can be used, but it cannot be sold. Okay, because this item has been used as a guarantee for the loan if the loan is failed to be paid. So if anything happen, meaning if the company is failed to pay for the debt, okay, then the trustee can take the asset possession, meaning they can take over the assets as a replacement for the unpaid loan. Okay, is that clear? Okay, the keyword here, you must put the point here, where there must be a specific asset to be charged. When you have identified the asset, meaning the business later on cannot sell the asset. Okay, the asset must be remain in the business, okay, as a guarantor for the loan. So if the loan cannot be repaid, then the trustees can take the possession of those assets. Okay, unlike unlike the fixed charge, floating charge is where the company can take any assets and put it as a group to be used as the charge over the debenture. When we say a group of non-specific asset, meaning the company can replace the asset if they think that the asset is not fit for the backup. For example, at the first agreement, the company decide to put the land as the charge over the debenture. But later on, okay, when the company thinks that the asset is not fit, they can change for other asset within the same group. Maybe previously you decide to use land at Kuala Lumpur, but after that you think that you want to use that land because it is profitable if you sold the land, so you replace it with other land, maybe land in other state. As long as it is the land is asset to your company. So you can replace the asset from time to time if you think that those asset is fit for the charges. So here the trustees can also take possession, but the asset is not fixed yet. So the company will decide later on which assets to be used as the floating charge. Okay, We done with A. Let us look at the computation B. The following is the extract of statement of financial position of Golden Berhad as at 31st December 2017. So these are the what? Balance brought down, because this transaction is for year end 31st December 2017. You are now going to record the transaction for the year ended 31st December 2018. So due to the information, okay, you can identify what are the transactions occurred during the year. If you look at number 1, okay, you are going to record the transaction for what? IPO. You have two types of shares, OSC and PSC. Okay, look at the first one. The company decided to issue another 300,000 ordinary shares at RM1.80 each and 3 million preference shares at RM1 each. What does it mean here? You are given the amount, issue and issue price. Okay, for both OSC and PSC. Right. Number 2. Okay, you have the information on what? The application were received and fully paid for 4,500,000 ordinary shares and 2,800,000 for preference shares. Okay, so here we have information regarding what? Amount received. So as you can see, for ordinary share, the amount received is greater than the amount issued, right? You have 3 million, but you receive 4.5 million. So you have an excess of how much? 1.5 million. So what you are going to do with the excess application? Reject and refund. As for the preference shares, okay, the shares is under subscription. No extra, no excess. Okay, so you can just allot the share to the successful applicant. Okay, last one is regarding what? Issuance of debenture. This is transaction regarding issuance of debenture. So in issuance of debenture, there are 5 informations that we have to identify. One of them is the nominal value of the debenture. How much is the nominal value? 3 million. Okay. And then the issue. Orang kata the issue price. But in debenture, we don't use price. We issue at either par, premium or discount. You have to find the amount later on. So in this case, the debenture is issued at discount because below than 100. Okay, the next information, number 3, is to know the nominal rate. How much the nominal rate? 6%. How much the effective rate? 8%. Lastly, do you have issue cost? Yes, you have issue cost by 15,000. And remember, your syllabus, we are using amortization method. Amortized method meaning the issue cost will be write off immediately from the fair value of the debenture later on. Okay. And dia kata lagi, at the end, the interest was paid. So please be very careful. The interest is paid, but interest is calculated on timely basis, right? So you have to be very careful on the timing. How many months to calculate for the interest, based on the date of the issuance. Okay, you are required first, generalize all the above transaction for the year ended. Narrations are not required, meaning you don't have to explain each of the entry. You just straight away determine the debit and credit entry. Okay, how to prepare the answer? You have to separate the answer according to the transaction. So we start with what? Let us start with the issuance of IPO first. We have IPO, right? So we start with IPO. We have 2 types of IPO. One is ordinary, one is preference. Okay, so this is step number 1. To record the amount that you receive 4.5 million unit times with issue price. So in total you have 8,100,000. Credit to where? Ordinary share application. Step number 2. Now, I need to break down this answer because this answer using the shortcut way. Okay, I don't want you to do the shortcut way. Since you are a beginner, please do the normal way as I taught you. So how to break down this one? Step number 2. You have to reject the excess application, right? Debit, I use the acronym OSA. Do you know what OSA, class? Ordinary share application. Credit what? Bank. So how to break down? How much do you reject? 1.5 million times with 1 ringgit 80 cent. So how much do you reject? 2,700,000. 2,700,000. Okay, then step 3. What is step 3? Allot the share. Betul? How to allot the share? How to allot the share? Debit, ordinary share application. Credit, ordinary share capital. By how much? So this one you replace 5,400,000 as step number 3. Is that clear, class? Okay. I edit the suggested solution because the suggested solution use the shortcut way. I want you to do the normal way. This is step number 1, step number 2, this step number 3. Don't combine step 2 and 3. Okay, you do the same thing for preference shares, but preference shares is easier because you don't have any reject and refund. So you straight away close the preference share application and allot the share to the successful applicant. Okay, is that clear, class? Last but not least, the issuance of debenture. Step number 1 is to record the amount of debt that you receive. You want to borrow 3 million, right? But you only issue at a discount. So, you only get 95%, okay, from 3 million. And don't forget, since you have issue cost, you have to minus the issue cost first. Therefore, in total, you only receive 2,835,000. Step number 2 is to pay for the interest. So, you have to calculate the finance cost. Another name for finance cost is interest expense. So, how to calculate interest expense? Find the amount that you borrow times with the effective interest rate. This is effective interest rate. And then times with the month. Why 5/12? You issue on August, right? 1st August. So August until December is 5 months. So you will get 94,500 ringgit. And then calculate the amount that you pay. The amount that you pay must be on the nominal value. So nominal value of the loan is 3 million times with the nominal rate times with the month. Similar, 5 months also, because we are still based on August, but we use different value. So overall, the company pay 75,000 out of 94,500. You still have balance, right? This is what we call the unpaid interest. So the unpaid interest will be added up to the debenture account to show that there will be increase in the liability during the year. Okay, so the difference is to be credited to the debenture, showing there is an increase in liability during the year because the amount still unpaid. So at the end, actually please add up another transaction here. You still remember? You have to close the finance cost account, right? Credit, finance cost is just a formality. 94,500 and debit to where, class? Retained earning. 94,500. You have to be consistent. If the question use retained earning, then you use retained earning. If the question use retained profit, then mention it as retained profit. We don't use open in this case since retained earning amount is given. Alright, so that's all about the computation. Okay, don't forget, we have another